Farms.com Market School with expert commodity analyst Moe Agostino is an online educational video series designed to help you, the farmer, improve your knowledge of grain marketing. Farms.com Market School is brought to you by DeKalb Brand Seeds. DeKalb, growing confidence. Today's video is about the different factors that affect the volatility in grain prices. Today's topics include factors that cause volatility in grain prices. That includes seasonality, weather, managed money, the speculators, economic cycles, international markets, USDA supply and demand reports, and outside markets including stock markets, crude oil, currencies. Our first topic today is about seasonality in grain prices. Here's a good example of volatility over a long period of time. It's the long-term chart on corn futures. Selling in the top quartile of that chart is equal to a very successful marketer. Selling in the bottom quartile is equal to a very poor marketer. Let's look at soybeans as our seasonality example. You can see from this chart that soybeans tend to bottom usually around October and then tend to rise as we get into the spring, summer the following year, and that's usually when prices peak. Here's another example of seasonality in Chicago wheat futures. In the past 5, 15, and 30 years, wheat futures tend to rise just after harvest, also known as the post-harvest rally. During late winter, early spring, prices tend to peak. Each year, again, is different. Some years better than others. Again, you can find these seasonal charts at www.mrci.com for a small yearly subscription fee. Our second topic today is about weather and grain prices. Prices usually are driven by supply shortages. Any production problems due to weather locally or internationally can cause prices to rise. A good example is the 2010 Australian flood or the 2012 U.S. drought. 40% of Aussie wheat turned to feed wheat. The U.S. average corn yield went from 163 to 122 bushels per acre. Futures jumped from 534 a bushel to 849 a bushel. The 2010 Russian drought is another good example. Russia decides to ban all grain exports in August of 2010. Futures jumped 335 per bushel in just a few months. The 2010-11 U.S. winter wheat crop was also very dry. Worst start since 2000. Yields dropped as much as 5 bushels per acre. Our third topic today is about the very large managed money crowd, or hedge funds, also known as speculators. There's been more interest in commodities by speculators in recent years. According to Barclays research, the number of assets invested in commodities has grown in 2012 to 420 billion globally. Volatility has gone up by 20% to a total of 50% in the past 5 to 6 years. In other words, the price of corn at US $6 per bushel can either go up by 50% one week to $9 a bushel, or it can go down by 50% in a week to $3 a bushel on increased volatility and increased limit up and down rules by the CME, Chicago Mercantile Exchange. When speculators are very long or bias is bullish, it's time to sell. Long means they think the price is going higher. Sell means, or short means, they think the price is going lower. When they're very long, take the contrarian view and do the opposite, like in 2012 when corn futures hit $8.49 a bushel, all-time record high. Here's a chart of where I'm tracking these positions for the speculators, whether they're long or short. You can see in 2008 they were record long, both in the beans, corn, and wheat. When speculators are very short or their bias is bearish, they think the price is going to fall, do nothing like the beginning of 2013. Prices tend to stop falling and start rising over time. You can find this information at CFTC, or the Commitment of Traders Report, provides you with a link. The CFTC stands for Chicago Futures Trading Commission, also the Commitment of Traders Report. Once you open up a web browser, go to Google, type in the CFTC report. This is the website that shows up. You scroll down to agriculture, click on long format. This is what shows up. The first part is Chicago wheat. You go to the managed money at the top, you subtract a long from the short, and that's how you get that net long or short position. Our fourth topic today is about economic cycles. The economic cycle goes into expansionary and contraction phases. Grain prices will usually fall into the economic cycle, so when you're in economic recession, demand falls, which equates to lower prices. When you're in economic expansion, demand usually rises and helps prices rise as well. Our fifth topic today is about international markets. Brazil and Argentina have become big corn and soybean growers. South America is now the largest soybean grower in the globe, overtaking the U.S. China is the fourth largest. U.S. produces 50% of the world's corn production. Argentina comes second, China third, and Brazil fourth. China's growing population, livestock, and middle class equals higher demand. Growing incomes equals more demand for grains and protein consumption. Feed demand also continues to grow, causing export demand to increase over time. China has increased U.S. agriculture inputs by 5-fold over the last 5 years and most likely will continue to do that in the future. Our sixth topic today is about USDA reports or supply-demand reports. When the USDA is throwing less bushels or less production, maybe lower acres or lower yield, this will cause ending stocks to drop, which will cause prices to rise in order to ration demand. The opposite can also happen. When the EPA is thinking of changing a policy such as the ethanol mandate, where they're thinking of changing the 2014 ethanol mandate from 13.8 billion gallons to 13 billion, this will usually cause demand to come down for corn usage, which will potentially cause lower corn prices. Watch for any increases in exports from a country as large as China. China can be a wild card and can increase export demand and vice versa. As the USDA lowers ending stocks, prices again need to move higher to ration demand. Corn ending stocks at 1 billion bushels or lower, at or below minimum pipeline levels, usually causes prices to increase. In 2008, 2012, U.S. corn ending stocks were as low as 673 million bushels. Our seventh topic today is about the outside markets, which includes crude oil, currencies, stock markets. Here's an example of that outside market. This is a US dollar index. It's a weekly chart. A lower US dollar equals higher purchasing power for international buyers. A lower US dollar equals higher export demand, which equals potentially higher prices over time. Most grains are priced in US dollars. Another example of that outside market is crude oil. Here's a crude oil weekly chart. Higher crude oil prices usually equals higher ethanol prices, although sometimes there can be a disconnect. Higher ethanol prices means more profits, more corn usage. A lower crude oil price equals a stronger U.S. economy, better meat demand, more feed demand, lower ending stocks, and eventually higher prices. The stock markets, also known as the Dow Jones Industrial Average or U.S. equity markets, is another good example of outside markets. When the investors or speculators are buying the stock market, driving it to record highs, that means they're bullish and confident. That's good news for commodity prices. When their risk appetite goes up, that means higher potentially for commodity prices and vice versa. And remember, U.S. corn is king. If one is bullish corn, one cannot be bearish soybeans and vice versa, but sometimes we do get a disconnect over short periods of time. A lower US dollar is usually equal to a higher corn price and soybean futures price. Why? Because a lower US dollar, remember, equals higher export demand, which equates to higher grain prices over time. Higher crude oil prices can also equate to higher ethanol prices, which means higher demand, higher corn usage, higher corn prices, and eventually lower ending stocks. So in summary, there are a lot of moving parts that one needs to watch, so a farmer's marketing plan needs to remain flexible to any future changes. The only thing I can guarantee you is future change. Remember, we can manage the risk and volatility, but we cannot predict the future. Thank you for spending some time with us today, and we hope that we have shed some light and insight on what causes volatility in grain prices. Thanks for watching. We look forward to seeing you next time.